Hey everyone, it is me again, and today I want to talk about something really personal, my financial past. It is not a pretty story, but it is an honest one filled with mistakes and lessons that I hope can help you. When I was in my early 20s, I was a lot like many of you. I guess I was dreaming big, wanting to make something of myself, and honestly wanting to make money. Fast, my background was pretty average. Just a regular family, so the idea of striking it rich, it had a huge pull. I did not have a mentor, no one to guide me through the complexities of investing. I just saw the headlines, the success stories, and thought, why not me? My journey into the investment world started with a lot of naive excitement. I was constantly bombarded with advertisements and stories about people making fortunes overnight. This was the era of easy money, or so I thought. Everyone seemed to be talking about the stock market, crypto, whatever the next big thing was. And I, with my limited understanding and huge appetite for quick gains, jumped right in. My first foray was into short-term trading. The allure was irresistible, the idea of buying something low and selling it high, all within a day or a week. It felt like a game, a thrilling one. I would sit for hours staring at charts trying to decipher patterns that probably did not even exist. I remember the rush of making a small profit, feeling like a genius, like I had finally cracked the code, but those small wins were quickly overshadowed by much larger losses. I would chase every tip, every rumor, convinced that this was the one that would make me rich. It was a cycle of hope, excitement, fear, and then disappointment. I was not investing. I was gambling with my hard-earned savings. Then came the scams. Oh, those were particularly painful. My desire for quick wealth made me vulnerable. I remember one specific instance where I was convinced to invest in a revolutionary new project that promised astronomical returns in a very short period. The pitch was slick, the testimonials were glowing, and my own greed blinded me to the glaring red flags. I poured a significant portion of my savings into it, believing it was my ticket to early retirement. Needless to say, the project vanished, taking my money with it. It was a gut-wrenching experience, a stark realization of how easily one can be manipulated when desperation and ignorance combine. One of my most significant errors was my complete disregard for risk management. I would go all in, putting all my eggs in one basket, believing in the infallibility of my chosen investment. Diversification was a word I vaguely knew but never truly understood or applied. My portfolio, if you could even call it that, was a high-stakes gamble riding on the performance of a single volatile asset. When those investments inevitably crashed, and they did repeatedly, the impact was devastating. It was not just the financial loss, it was the emotional toll, the stress, the anxiety, the feeling of utter failure. I was constantly reacting to market movements, buying high out of fear of missing out, and selling low in a panic when things dipped. My emotions were my worst enemy, steering my decisions more than any logical analysis ever did. Looking back, I see a young man who was desperate to prove himself, to achieve financial freedom, without understanding the fundamental principles of how wealth is actually built. I was so fixated on the destination, on the idea of being rich, that I completely neglected the journey, the learning, the patience required. I bypassed all the necessary steps, trying to leapfrog to the end, and in doing so, I stumbled and fell hard. I ended up losing a substantial amount of the money I had saved up over years, money that represented my efforts, my dreams. It was a dark period, one that forced me to confront my misconceptions and my naive approach to money. But as painful as those losses were, they were also the most valuable education I ever received. They served as a harsh but necessary wake-up call. I realized I could not continue down that path of reckless speculation. I had to fundamentally change my approach, my mindset, my entire philosophy about money and investing. So I stopped chasing the latest trends. I stopped listening to the anonymous internet gurus promising overnight success. I stopped letting my fear and greed dictate my financial decisions. Instead, I started to learn properly. This time, I devoured books on personal finance, economic history, the principles of sound investing. I sought out reputable sources, not for hot tips, but for foundational knowledge. I began to understand concepts like compound interest, asset allocation, the importance of a diversified portfolio, and the true meaning of risk management. These were not exciting, flashy topics, but they were the bedrock of sustainable wealth building. I learned that true wealth is not built overnight, but accumulated steadily, consistently, with discipline and patience. I realized that ignoring the noise and focusing on a long-term strategy was far more effective than constantly chasing fleeting opportunities. My approach to investing today is radically different. I prioritize capital preservation over speculative gains. My focus is on stable, low-risk investments, building a well-diversified portfolio, and maintaining a robust emergency fund. I am not looking for adrenaline rushes from market swings. I am looking for peace of mind and steady, consistent growth. It is a far more deliberate and, frankly, boring approach, but it is also infinitely more effective and less stressful. One of the most profound lessons I learned, and something I often reflect on, is the distinction between actual money and mere currency. This concept really hit home after my financial misadventures. We all use paper notes, these Federal Reserve notes, every single day, and we instinctively consider them money. They even state, "This note is legal tender for all debts, public and private." We are taught from a young age that these pieces of paper are money, but are they really? I have come to realize that they are not. They are essentially promises, tokens whose value is derived solely from our collective belief, our societal agreement that they have value. They possess no intrinsic worth. True money, historically speaking, has always had inherent value. That was a crucial distinction I missed in my early misguided investment attempts. I was chasing perceived value, which can vanish in an instant, instead of pursuing true intrinsic value. Murray Rothbard, in his seminal work The Case Against the Fed, articulated this concept brilliantly, and his insights, penned decades ago, resonate with striking relevance today. He provocatively questioned the prevailing narrative by arguing that if inflation, the insidious erosion of our purchasing power, is primarily a consequence of the continuous expansion of the money supply, and if the Federal Reserve in the United States holds the exclusive monopoly on money creation, then who ultimately bears the responsibility for inflation? It appears to be a straightforward question with an equally straightforward answer. If the Federal Reserve is the singular entity creating money, then logically, the Federal Reserve is the primary driver of inflation. Yet paradoxically, we are perpetually informed that the Federal Reserve is the sole institution capable of combating inflation. It presents a bewildering scenario, akin to a pyromaniac positioning himself as the only capable firefighter it is, as Rothbard aptly described, an elaborate shell game, a masterful feat of propaganda. Rothbard vividly illustrates this paradox with the analogy of a thief having just committed a robbery, running through the streets shouting, "Stop thief, stop thief," while being the culprit themselves. This analogy perfectly encapsulates the disconcerting feeling that often arises when observing certain aspects of our financial system. The very institution that is fundamentally implicated in the creation of a problem is simultaneously presented as the exclusive purveyor of its solution. It is a narrative that, once critically examined, compels one to question the underlying motives and structures at play. This philosophical contemplation of money and power gains even greater urgency when we examine the contemporary financial landscape. The United States currently grapples with an astronomical national debt, a figure stretching into the tens of trillions of dollars. A seemingly minor increase in interest rates translates into hundreds of billions of dollars annually, allocated solely to servicing this debt. This colossal sum is diverted from essential public investments such as infrastructure development, educational initiatives, or programs designed to stimulate economic growth. Instead, it is consumed by the ever-growing burden of debt interest. Furthermore, the persistent specter of inflation continues to loom. Large elevated oil prices, ongoing geopolitical tensions, and a general erosion of investor confidence in traditional assets like U.S. Treasury bonds compound the problem. Investors, increasingly discerning, scrutinize bond yields and often find them insufficient to compensate for the inherent risks involved. Consequently, as demand for these bonds wanes, the U.S. government is compelled to offer progressively higher yields to attract buyers, thereby exacerbating the debt burden and initiating a precarious downward spiral, a phenomenon I frequently refer to as a debt doom loop. It is an inherently unstable and concerning situation, and here is where Rothbard's insights become even more unsettlingly prescient. He meticulously documented, and it remains strikingly pertinent today, that institutions like the Federal Reserve have historically engaged in practices that appear contradictory to their stated objectives. Consider this. Since December of 2025, the Federal Reserve has actively purchased vast quantities of U.S. Treasury bonds, amounting to nearly $250 billion. This raises a fundamental question. How can the very institution, the singular and ostensibly paramount protector against inflation, simultaneously, with its other hand, be acquiring bonds that, by increasing the money supply, inherently contribute to inflationary pressures? This, Rothbard contended, is the essence of the shell game. He further elaborated that this seemingly contradictory behavior underscores the perennial importance for the Federal Reserve and other central banks to cultivate an aura of gravitas, inscrutability, and even mystique. As he presciently noted, if the public were genuinely aware of the true nature of these operations, if the veil obscuring the enigmatic Wizard of Oz were torn away, they would swiftly come to the profound realization that the Federal Reserve, far from being the indispensable antidote to inflation, is in fact its very genesis and perpetuator. That particular passage, it resonates with me every single time I read it, and he concludes with an even more radical assertion, stating, "What we need is not a totally independent, all-powerful Fed. What we need is no Fed at all." Those words, written over 3 decades ago, possess an unnerving relevance in our current economic climate. Now, before anyone hastily interjects with the argument that a Federal Reserve is an absolute necessity, let me address this notion, that we must have a central bank, is precisely part of the narrative, the propaganda, if you will. What if, instead of entrusting a committee of unelected officials with the immense power to control not only the global reserve currency and our entire monetary system, thereby directly impacting your and my financial well-being, but also the wealth we hold in dollar-denominated assets. What if we allowed the principles of a free market to govern? Imagine a system where the cost of borrowing was determined by the natural forces of supply and demand, much like any other commodity or service, mirroring how economies functioned before the widespread establishment of central banks. But therein lies the rub. Such a system would necessitate real money, a true store of value, effectively placing inherent constraints or handcuffs on an institution that currently operates with virtually unfettered discretion. Consider for a moment a world operating with genuine money. Envision a return to a system anchored by something tangible like a gold standard, where the creation of new currency units from thin air would be impossible. While some might dismiss this as an impractical or even anachronistic fantasy, such a framework would compel banks to operate with a far more acute and genuine appreciation for risk. They would be precluded from engaging in reckless casino-like gambles with our collective funds, from constructing colossal derivative structures based on nebulous foundations, all for the singular pursuit of their own burgeoning profits at our considerable peril. Crucially, it would signify that if you diligently labored and prudently saved, your savings would genuinely retain their purchasing power and intrinsic worth into the future. Now, I acknowledge that this proposed system is unlikely to be universally perceived as flawless. I am certain there would be legitimate criticisms and potential drawbacks. However, my central contention is that the current Federal Reserve System as it operates today is functioning precisely as it was designed to inflation. As I have painfully learned, is not an unforeseen consequence or an accidental byproduct, it is rather a deliberate policy. And the institutions involved are remarkably adept at leveraging this policy to facilitate a strategic transfer of wealth from the many to the privileged few. That ultimately is the insidious nature of inflation. It functions as a clandestine tax, one that neither you nor I ever voted for, silently diminishing our accumulated wealth. And wealth, it bears remembering, does not simply dissipate into thin air. It merely changes hands. It gravitates towards those positioned closest to the source of its creation, those at the apex of the financial hierarchy, while the vast majority experience a gradual and sometimes rapid erosion of their prosperity, year after year, month after month, day after day. Now, I am not here to prophesy an imminent return to a gold standard or any specific fixed monetary system. My primary objective is to convey that the intricate system they painstakingly constructed, the very mechanism they have employed to exert control and influence over the American populace, is demonstrably faltering. The alarming trajectory of bond yields, the escalating national debt, and a myriad of other economic indicators all point to this inexorable weakening. However, it is imperative to understand that the eventual collapse or restructuring of this system does not automatically herald an era of widespread liberation or immediate financial freedom for the general public. Regrettably, what it more likely signifies is that those individuals who have predominantly confined their wealth within the conventional system, specifically in dollar-denominated assets, be they investments in the stock market, various bonds, or even traditional cash savings, are precisely the ones who stand to incur the most substantial losses. Nevertheless, amidst this challenging outlook, there concurrently exists a profound opportunity. This opportunity is primarily available to those who have strategically chosen to hold assets that genuinely possess a true and enduring store of value. There is indeed a beacon of hope at the culmination of this protracted tunnel, a viable pathway to safeguard your accumulated wealth. This protection extends beyond merely shielding your assets from the insidious effects of currency devaluation. As the US dollar continues its discernible decline, a pattern consistently observed throughout recorded history in cycles of currency resets and monetary transformations,